difficult day for this man here. He is, of course, the former IMF economist Raghuram Rajan, who's just taken over as governor of India's central bank. And he's surprised global financial markets in the last hour or so by raising interest rates by 0.25% to 7.5%. It's a controversial move aimed at controlling inflation and helping to prop up the rupee, which has plunged by more than a quarter in recent weeks. But it's going to annoy many in business, not to mention the government, who want to see lower borrowing costs to boost India's growth, which is at its weakest in a decade.
Markets weren't expecting this move. Both indices plunged. Rajan also partially rolled back some of the measures taken to prop up the rupee. The daily CRR requirement for banks have been reduced from 99% to 95%. The rate at which banks can borrow emergency funds from RBI, the marginal standing facility, has also been reduced.
Raghuram Rajan announced his maiden monetary policy and surprised the bankers and the corporate sector. In a mid-quarter monetary policy review, Reserve Bank has hiked the key repo rate by 25 basis points, which now stands at 7.50%. Repo rate is the rate at which banks borrow money from the Reserve Bank of India. Meanwhile, the cash reserve ratio, or the amount of money banks have to park with the RBI, has been kept unchanged at 4%. RBI also reversed some of other rupee supporting steps. He relaxed the requirement that banks meet 99% of their CRR on a daily basis. Banks will now have to meet 95% of their CRR on a daily basis. RBI has also decreased the marginal standing facility by 75 basis points to 9.5%. Reduction in marginal standing facility will bring in marginal liquidity in the market.
In mid-quarter review today, we began a calibrated change in the exceptional liquidity measures we introduced in July by cutting the marginal standing facility rate, which is the effective policy rate today, by 75 basis points or 0.75 percentage points. We also reduced the minimum daily CRR balance that banks have to maintain to 95% of the requirement. We believe that easing the exceptional liquidity measures was warranted, given that the external environment has improved and given that the government and the RBI have used the time since the measures were put in place to narrow the current account deficit and to ease its financing. The calibrated withdrawal will provide a boost to growth, reduce the financing distortions that are emerging in the market, and reduce the strain on corporate and bank balance sheets. We remain vigilant about external market conditions and will do what is necessary if they deteriorate once again. Let me emphasize that the difference between the MSF and the repo rate will be brought down to 100 basis points. At the same time, recognizing that inflationary pressures are mounting and determined to establish a nominal anchor which allows us to preserve the internal value of the rupee, we have raised the repo rate by 25 basis points. The RBI has always looked at both rates, and of course with CPI you could talk about CPI new, industrial worker, rural worker, etc. We have to take everything into account, because remember, the WPI inflation rate doesn't contain, for example, a significant portion of services inflation. So you can't just focus on one. But I think till we get the report from Dr. Urjit Patel and his committee, I would refrain from saying, we have a focus on explicitly on a particular measure. I thought we would have to worry a lot about what Fed policy would be, but our policy was actually quite easy even before the Fed did announced. I mean, there were some I's and T's we crossed, and I's we dotted. But in general, I think this is the course we have to take in order to stabilize the economy. And we need that stabilization regardless of what the Fed does. Of course, if we stabilize, we are better prepared for the tapering whenever it happens. But let's not lose the chance, the warning that we have been given, and celebrate too early that this is going to come back. And what we need to do is put our house in order before it comes back. I would not overestimate the effects of a 25 basis point repo rate increase. Of course, there is, our intent is to signal a stance against inflation, but I won't overestimate the negative effect against growth, on growth.